Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice, as I have access to the lowest rates at the lowest costs in Arizona. And if you don't believe me, call me. Here is this week's mortgage market at a glance. This week, the Fed announced a reduction in its bond buying. In separate news, the big jobs report was much stronger than expected. Both of these events should have pushed rates higher. So why didn't they? Let's start with the Fed and its bond buying adventures, also known as quantitative easing. The following chart of the 10-year Treasury yields, a broad benchmark for rates, shows the paradoxical reactions to the Fed's previous decisions of stop buying bonds. In other words, we knew a paradoxical reaction was a possibility, even though the precedent is never a guarantee. Beyond that, we also knew that rates were moving higher in anticipation of the Fed's eventual exit. In fact, by last week, they'd already covered as much ground as they did in 2013. All that to say, the reaction to the Fed announcement has arguably been in the works for more than a year. In that sense, it definitely pushed rates higher, but far in advance. September 22nd offered the most recent example when the Fed more overtly telegraphed the contents of this week's announcement. Incidentally, the bond market's first reaction to this week's tapering announcement was also to move slightly higher in rate. The recovery didn't happen until the following day, so what caused the drop in yields? And how about the even more puzzling drop the next morning after the strong jobs report? You can see both drops in the red highlighted areas on the following chart. These sorts of pops and drops rarely boil down to only one root cause. Some traders aren't even taking such timely events into consideration. But if I had to pick only one leading suspect, the unexpected catalyst for most of the other drama, it would be the Bank of England. How does that even matter to rates, you ask? Well, in fact, there's a strong correlation between bond yields in the US and Europe. Each will take turns providing inspiration for the other. The correlations are especially noticeable when one of the major central banks sparks a big move in the respective country's sovereign debt yields. In other words, if the Bank of America does something to make British bonds drop precipitously, that will almost always result in at least some downward pressure on U.S. bond yields. With that in mind, let's look at another version of the previous chart. This time I'll examine the outright change in U.S. Treasury yields since Tuesday and compare that to the outright change in British 10-year yields. If anything, the U.S. bond market was trying to resist the pull of the British bond market on Thursday. When that assault continued on Friday, it forced traders to close or cover their bets on higher yields, aka short positions. The result is known as short squeeze, and its momentum is only limited to the amount of short positions in the market, and there was a ton of them. A surprisingly bond-friendly series of events in the UK spilled over to put downward pressure on U.S. yields. U.S. traders weren't prepared for yields to move as low as they did, and thus were forced to surrender by buying more bonds, which pushes yields even lower in order to cover their short positions. Lastly, if you had any doubts about the British inspiration, we can simply observe the red line dropping more than twice as much as the blue line since Tuesday. In a much bigger picture, we can also keep an eye out for shifts in the relationship between COVID and the market. To some extent, we're seeing a similar pattern play out to the ones earlier in 2021 when case counts stopped declining and rates stopped rising. And so there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that is for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. Until next time, take care and stay safe.